Hello, on today's edition of the Final Bar, we're going to open the Final Bar Mailbag, answer some questions about long-term moving averages, about institutions and how they sell rather than buy, and also answer a question about China ETFs that came up from earlier this week. We'll have a pro tip. We'll talk about the scanning tool and how to incorporate it in your process. And my guest, Roman Bogomazov, talking about Wyckoff analytics. Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to today's show, The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us today and every weekday after the close to look at today's price action, think about the short-term movements and how they relate to the long-term trends, which is so important as an investor to have a proper time orientation. Hopefully we'll help you get there today. My guest later is Roman Bogomazov. He's based down in San Francisco. He's an expert in Wyckoff analysis, has done a lot with StockCharts over the years, and is going to share his chart of the S&P 500, how to break it down from a Wyckoff perspective, which should be really, really interesting. We're also going to open the Final Bar mailbag. As a reminder, you can get questions to us any time of the day or night. The Final Bar at StockCharts.com. Just shoot us an email with what you're thinking. We've gotten a lot of really good questions. We picked a couple of them out today to review on the air with you today, together, and keep them coming, please. And also feedback on the show and how we're doing. I did want to remind you, we have the event coming up on January 4th, Market Vision 2020. This is a fantastic event headlined by John Murphy, the Chief Technical Analyst here at StockCharts. We'll be joining Tom Boley, Julius DeKempeter, Aaron Swenlin, a number of names that you're probably familiar with, breaking down their market outlook for 2020. I'll be presenting as well with some of the charts that I think are most important to think about in the coming year. So please check it out if you haven't already. Let's get to our market recap. Let's break down today's trading and think about, again, the short-term environment related to the long-term trend. So, you know, a little bit of selling today, but really just a little bit. I mean, overall, we had this nice run into this week. And so far this week, it's been sort of sideways, sort of choppy, right? So Monday, Tuesday into Wednesday, sort of tapering off. Not a huge directional move. This is sort of, think of it psychologically as digesting the gains of the last couple of weeks, which in any sort of bull market environment, you need to have those days where you process what's come before, prepare for what's coming next. The question on many minds is this just a pause before we continue? And we continue to see new highs. Again, we're in the seasonally strongest part of the year, November through April. So we can continue to see that pattern, continue to see a Santa Claus rally into the January barometer, breaking, strengthening and continuing to see leadership. Or do we see more of a distribution? And if there's one worrisome issue, it's this bearish divergence that's potentially starting to form a sort of a non-confirmation of higher highs in price, but lower peaks in the RSI. And again, it's too early to decide whether or not that is what's happening. But anytime the market goes to new highs and you see this sort of pattern, it's going to be something to think about. And there are a lot of charts. We're going to look at one a little later. If I remember right, I think broker dealers, if I remember right, one of the industry charts I was going to bring up in a little bit saw a similar type of pattern. Looking at just today's trading, you can see how the end of last week, Thursday and Friday, we sort of gapped up into Monday, and then it's been sort of sideways. And again, this is all sort of relative based on the volatility. So these huge swings on Thursday and Friday are making the last couple of days look relatively muted on the chart. There's plenty of movement in here, but overall, not real directional movement. That's what you saw on the daily chart as well. The last couple days, if you look, the last 30 minutes of trading each day this week has been weaker. So you've had selling going into the close in general. And again, this is a broad assumption, but that's when institutions are going to make a lot of their movement. So certainly feels more like profit taking or some sort of distribution going into the close. Again, that doesn't necessarily, that's one data point suggesting weaker rather than stronger. But I think it's interesting to notice that daily pattern there. And we've seen it a couple times here. Let's look at the member dashboard, sort of see what sort of themes have evolved here. The S&P actually finished down just slightly for the day. And this is the chart we're looking at. It's the last 2 days on the S&P. So, a lot of choppiness when you just look at the last 2 days, but you can see the sell-off in the last 30 minutes. We actually closed below yesterday's close, which is it's a bit of a surprise because we were a pretty decent up move for most of the afternoon there. The NASDAQ was up slightly. Small caps were the only of these indexes up in a meaningful way. And again, only 38 basis points. So not much of a move there, but small caps above large and mid today. The sector story is real estate. Real estate's the #1 sector, up 1.3% at a time when the market was flat to down. Communication services #2. At the bottom of the list, you have industrials and financial. So really a mixed bag of sectors. There wasn't a real clear sector tilt from offense versus defense. They're kind of choppy. You have utilities. The third top sector, energy, had been much stronger, kind of sold off into the close. So a little bit of a variety and not a real directional sense there. In terms of stocks and what sort of movements we've seen, I want to show just a couple industry charts just to think about those. One of the pages that I look at a lot is this industry candle glance page. This is looking at industry indexes. These are some of the more commonly referred to ones and ones that I like to pay attention to. A couple themes that jumped out as I was looking at these this afternoon. #1, the oil services index. So energy finished, not the strongest sector, but not too bad, actually, improving pretty well. And look at how the OSX, the oil services index, has actually recovered quite nicely. And I've mentioned with a number of the guests over recent month or so, what if energy actually emerges in a position of strength? How unprepared would most investors be for that? Because we just haven't seen that in a while. I haven't seen commodity strength, energy outperformance. But overall, again, in a vacuum, this chart actually looks pretty decent. You have sort of this consolidation pattern of higher lows and lower highs. Now a break above there. We're testing the 200-day from below, just reaching the overbought level. So potentially nearing some resistance area, but overall an improving chart, a chart with improving characteristics that's sort of unusual. Natural gas as well, breaking to a new swing high, a new closing high there recently. Broker dealers, XBD is another group I wanted to look at. I mentioned in the introduction with the S&P 500 that sort of non-confirmation, that bearish divergence, and the broker dealer index, which is part of financials, has actually probably confirmed that at this point. So you have a higher high-end price, lower peaks in RSI, so a real indication of distribution, of an exhaustion of momentum, potential downside here. So interesting in financials, which have been sort of the poster child for a new sort of cyclical bull rally going into the new year. Something like the XBD is starting to show a bit of a distribution there. Final chart I wanted to show you in terms of an industry was automobiles. So the auto index, if you look at the groups, automobiles are actually one of the top industry groups today. So if I look down here at the Dow Industries, it's the #1 performing group, up almost 3%. But if we look at the individual chart, it's this one, you can see what's actually happening there. So remember, with some of these groups, the members of the group might surprise you a little bit. The top ranked stock in this auto group is actually Tesla. So the traditional sort of Detroit auto companies, not anywhere this attractive, but look at how Tesla has rotated back above resistance in this beautiful stepwise climb, sort of going to the moon, another closing high, another high for the year today, and overbought, but nearing that extreme overbought region, which usually suggests further upside. So auto is a really interesting group on the move, driven by Tesla today. So that's our market recap for today. I want to go next into our Final Bar Mailbag. One of my favorite parts of the show is keeping it interactive, and we've gotten so many great emails from many of you over time asking about different parts of the market, asking about charts that we show, and so forth. So I wanted to go through a couple of the questions that we received just in the last couple days, and keep the questions coming. The Final Bar at StockCharts.com. Just shoot an email with any of your questions. We'll get to them as soon as we can. So this is actually, I did a webcast yesterday morning in preparation for that Market Vision 2020 event, which is coming up on January 4th of next year. I did a webcast earlier this week, which is on YouTube. You can find it there. I talked about investor routines, and I walked through my daily and weekly chart routines. Might be of interest if you haven't seen it. And one of the questions that actually came out of that event when I wanted to address was the long-term moving averages I showed. So the weekly chart that I start with, I have a couple different things that I look at, but one of the main models I use is using the 21 and 34 week exponential moving averages. And the question was, why am I actually using those particular settings? What other settings are people using, and so forth? So the quick answer of why I use the 21 and 34 week, To be honest with you, I started with Fibonacci numbers and I was using 5, 13, 21, 34, 55. You probably know the numbers as I do, and tried different combinations of those just as a way with exponential averages to see what overall would keep me on the right side of the secular pattern in stocks. And I settled in on the 21 and 34 week years ago, as it just made sense. It tended to favor stocks. When I would favor stocks, it didn't overreact, so it wasn't very noisy. Very rare signals, but meaningful signals. And so that's what I've used. A number of other people I know and respect use the 13 and 34 weeks. So Ned Davis, I've spoken to, uses that as part of his Big Mo model. Arthur Hill and I've talked about using those averages. So there are a number of combinations I think that are helpful. What's interesting is that they are long-term exponential averages using weekly charts. And I think that's probably the key. Any of those combinations is gonna work pretty well in a lot of different scenarios. The trick that I found is picking one combination that makes sense for you and that lines up with how you would naturally be trading something, and then stick with that pattern over time. And that's why I've used the 21 and 34 week exponential moving averages for years, and it overall served me pretty well. The second question was on institutional selling. And as you probably know, my background to some degree is in institutional investing. So I worked at Bloomberg for years working with institutional investors, and I also was a director at Fidelity and spent time with portfolio managers there. And so the question is, how do institutions actually think about selling? And I think that's obviously, that could be an hour-long discussion just answering that question, but I'll give you the quick version. In general, what I've found is, as an individual investor, when a stock hits a certain objective, let's say, you are long Facebook back here earlier in the year, and the price hits 180, and your mental target, your profit-taking target is 180. So when it hits 180, you are happy taking some off the table because it's reached your objective and you're good with that. On average, though, most institutional investors, especially with a big benchmark name like Facebook, so if I'm trying to outperform the S&P 500, I better be able to outperform Facebook or be on the right side of Facebook. Otherwise, if it's doing really well and I don't own it, that is a huge performance hole that you have to dig out of because you're underweight one of the best performing names in your space. And one of the challenges are that the FANG names had been so strong and they were such a big weight in the benchmark, institutional managers had to own them because it was such a big weight and they were doing so well. As a result, the trends tend to persist because institutions have to remain holding those stocks that have worked very, very well. That's very interesting, especially here at year end when there tends to be window dressing. You tend to sell out of more speculative names and get into more top performing names, so your portfolio looks pretty good for a quarterly snapshot. So having said that, as an institution, when Facebook hits 180, you probably, all else being equal, would not be inclined to start taking profits or start selling it because you need to own big stocks that are doing very well. So overall, that's why I think the trends in some of these larger names, especially in tech and consumer, have stood the test of time, have done so well, so consistently, because institutions aren't really incentivized to sell them in any meaningful way. It's better to hold a big benchmark name, especially if there's a chance it's going to outperform. The problem, though, is when they do unwind, there tends to be a huge capitulation because once someone starts taking profit and it starts hurting your performance, it's a huge weight on your neck as you're trying to come up for air in a downtrend. And so there will be a lot of concentrated selling very quickly. And people have often said stocks, take the stairs up, and they take the elevator down, or some variation of that. And that's part of why that tends to happen. So, that is a very quick version of how institutions sell. I would say in general, institutional investors tend to be more trend followers, especially technically oriented ones that I've worked with. And as a result, we'll use on some trend following mechanism, moving average rollovers or something like that as a way to exit positions. They won't try to pick a top. They'll try to get out and take profits after some of the pain has started to be felt. So thanks for the question on institutions. Hopefully that helps give you a little color. The third question I wanted to address on the mailbag segment was about China ETFs. We actually talked about this a number of weeks, if not months ago. We had a question on this, and I just wanted to revisit it. So I was talking about the FXI yesterday, or the MCHI, I forget which one. And the question was, why are you using that particular China ETF, and asked about some of the other ones. So there are a number of ETFs that give you exposure to China. The two that I tend to use most often are the FXI, and I'm showing you the daily return, relative return starting, or percent return starting at the end of last year to where we're at today. But there are others. The MCHI, which is another one, is one that I use very often. FXI is iShares and so forth. So each one of these, the weighting is going to be different depending on what types of stocks they're looking at, and the sector weightings are actually dramatically different. So the FXI is over 50% financials. It's a huge weight on the big financials that are in general tend to be more state-owned enterprises that are tied to the Chinese government. There are others that are also pretty liquid, and I'm showing 4 others here as well. So the FXI is that black line that I showed you a moment ago, up 13% year to date. All the other ones are actually up much more. So we have things like the MCHI and the GXC. These are the S&P and other ETFs. They have much more of a weighting in big technology. So something like Alibaba, Tencent, or 30+% of those ETFs. You have a much bigger technology weighting. There's ASHR, which just focuses on A shares, which is going to be a lot of companies you're probably not familiar with because they're not listed on the Hong Kong Exchange. And then there's XSOE, which is the state-owned, non-state-owned enterprises, which focuses on really it's a lot of technology names that aren't tied to the Chinese government. So this is a cautionary tale of sorts to say when you want exposure to China, there are a lot of ways to do that, and you're going to get different weightings. So make sure you dig one level deeper on some of these ETFs, especially with some of these sector and government exposures you're going to have, because it could certainly affect your returns, as you can see from those 5 China ETFs looking year to date. We're going to take a quick commercial break. We're going to be back with my guest, Roman Bogomazov, on Wyckoff analysis. See you in a minute. Hello, everyone. Welcome back to today's episode of the Final Bar. We're joined today by Roman Bogomazov from Wyckoff Analytics, joining us from San Francisco, sharing his take on the broad market environment. Roman, welcome to the show, my friend.
David, thank you so much. I always enjoy coming to StockCharts TV, and first time I'm working with you, so it's very exciting to be on the Final Bar.
Roman, hopefully not the last, and you've done a lot of really good work for StockCharts over the years. Thanks so much for that. The chart that you sent is wonderful, and I have such an appreciation of the Wyckoff method. I've always enjoyed hearing from you and others that are familiar with it. So I'd love to hear you talk through what this is telling you about the S&P here.
Absolutely. The first point that I want to make, and I'm going to make 3 main points, and hopefully we're going to have a very short discussion after this. My first point is that it's an uptrend. Higher highs, higher lows. I keep hearing, and I talk to a lot of students, a lot of traders, that there is still such a negative sentiment about where we are in the structure, how we travel there. So if you look at the chart, don't resist the uptrend. It's higher highs, higher lows. So we are there. Having said this, we definitely, might have some kind of short-term reaction, especially here. We are hitting some of the trend lines, as you could see. And I would be expecting that around 3,200, 3,250, there might be some kind of short-term pause, but still to the upside. And then possible, conversation that, us Wyckoffians would usually have is about upthrust. Is this an upthrust, or is this a sign of strength? Well, the upthrust action, like we observed in the September, October of 2018, another one was in July of 2019. Usually it's a temporary commitment above the previous resistance and then almost instant comeback into the trading range structure. We don't have it now. We had a moment at the end of October and actually throughout November where we had some short-term supply coming into the market, but that has been resolved and supply has been vertically absorbed and suggested continuation of the price movement to the upside. My second point is that the horizontal counts, and you could see 2 counts here, the original count from the shakeout action at the end of 2018 into the automatic reaction into February of 2018 leads us to the target of 35.25. That target is being confirmed by another horizontal PNF count, which we could find on the backing up action in 2019, and that also points to 3,500. Whenever we have confirming counts, this is a really good indication of where potentially the price could go and where potentially we could have another stop in action. Another point that I want to make is look at the trend lines. Again, I have two channels here. One is a very short term, and we are accelerating in that channel. And then another one is more of the intermediate kind. And we're seeing how we are bumping into the mean of that, mean trend line. So once we overcome that 32.50, I think we might have actually accelerate into the green box and into the overbought condition. Dave, do you have any questions, maybe thoughts, maybe comments? Let's talk about this.
It's a great chart, Roman, and I love how you framed it out because, as I'm looking at, as you're talking through your last point, you see this acceleration, and I know for so many investors this feels relatively extended, but when you put it in proper perspective, coming back to the shakeout at the end of last year, we're actually at the midpoint of that overall trend, right? It doesn't feel that extreme. I'm curious though, my question would be, how do you reconcile this with what, I don't know if you caught at the beginning of the show, one of the issues we've had on the S&P, on Apple, on Disney, on broker-dealers, on healthcare, are these non-confirmations, something like RSI showing lower peaks while we see higher highs in price. How does that relate to what you're showing here, suggesting some further upside?
Such a great question, and I'm showing here that supply is decreasing on the volume signature. You could see that the volume overall just goes down as the trend advances. One of the things that I want to point our viewers' attention to is the liquidity events, the one that happened in January, February of 2018, and then absorption into March, April. This was a rotational liquidity event. So there were a lot of profit taken, and then new positions were established. The same happened in October, November, December, also a huge liquidity event. And obviously the whole structure is being influenced by the external events like tariffs and so on and so forth. But those events allow institutions to change their portfolio, make the rotation in the portfolio in such way that allows them to absorb a large number of shares. And that absorption of the supply allows the trend to stay on and to be sustainable. We have some pockets of smaller liquidity somewhere between May and October of 2019, and those are so much minor in comparison to 2018 events. So once the supply is in strong hands, it does not require a lot of effort on the demand part to push the price up. So therefore, we will see that non-confirmation from the volume in general, non-confirmation from the demand, and also the momentum is going to show in a different way rather than from the points of high liquidity. David?
Roman, that is one fantastic chart and a series of fantastic comments. I can't thank you enough for coming on. I'd love to have you on in the new year if you'd be up for it.
Absolutely. Good to be here.
Roman, have a great holiday. Thanks again for sharing your take.
Thank you.
Folks, it's Roman Bogomazov from Wyckoff Analytics. I tell you what, I am not a Wyckoffian, and I have learned over my career to pay special attention to people that use a different set of disciplines that has value, and someone like Roman has a lot to offer. So that's really a great take on the markets. Our next segment is called Protip. We're going to just spend a couple moments sharing a brief insight on the StockCharts platform, something that I think people don't use enough that they probably should. We're going to go to the member dashboard. So I'm going to click here. And what I wanted to talk about in particular, I was talking with Grayson Rose, who's part of the management team along with me here at StockCharts. We were talking yesterday about different parts of the platform. We ended up talking about the predefined scans. And we have found on our platform, this is actually one of the pages that's not used as much as we certainly feel it could. And there's so much value here because what it does is it automatically has a bunch of pre-set up scans for you by the type of indicator and then by the exchange. And so you can see it for equities and also a section for funds at the far right. And this basically illustrates how many stocks fit each of these different categories. And you can click on one of the listings. You can then sort that list by scooter ranking, by market cap, and you can look at certain types of companies. You can sort it by sector and see what sort of stocks come up to the list. And then you can click on the ticker to actually see the chart and drill down to it. So what's interesting, two things I will share with you. Number one, this is a really good way to get a sense of how you can look for ideas within the equity space. So for example, oversold with an improving RSI, only one NYSE name that fits that, and I'm going to bring it up. So this is actually showing something that's had an incredibly weak RSI, but just coming out of that oversold region. So if that's the type of way that I tend to look for stocks, it's a great way to just sort of focus in and see which names fit that category. The second way you can use it is by looking at how many stocks actually surface here. So only 17 stocks, only one on the NYSE, one NASDAQ, 6 NASDAQ stocks fit that category. If you look at the comparable screen down here, which is overbought with the declining RSI, you have about double the number of companies that are overbought with the declining RSI. So it's a great way to see what's sort of coming up there. The other thing you can do then is use those predefined scans as a way to build your own scan. So if you go to the main scanning engine, you can actually bring in one of those predefined scans as a starting point. So this is the listing that we just looked at before. You can actually insert that right into your advanced scan and then start to customize it from there. So it's a great way to see what's out there. Use it as a breadth indicator to see which stocks are hitting what filters, and then use it and add to it, augment it, adjust it, and make it your own, and use it as something you can pay attention to over time. So that is our pro tip for today. And folks, it is the end of the show and time for the 3 in 3. So 3 charts in 3 minutes, and let's get right to it. So the first chart is the stock versus bond ratio. I was interviewed this morning on a podcast, on a webcast, and we were talking about stocks versus bonds. They were asking about interest rates and how it relates. And this is the chart that I showed them, illustrating the relative performance of the SPDRs SPY to the TLT, the long bond ETF. And this has clearly been favoring long bonds for the last 2 months. There was this period here in November where all of a sudden it felt like, okay, this might be a rollover. It's breaking back below a 200-day moving average. Maybe this is more favoring bonds again, but we resolved right back higher. Now we have stocks at new highs, the TLT, testing support, if not breaking down a little bit, still favoring stocks. So until this ratio rolls over, it's really not suggesting that you reallocate away from risk on to risk off, or away from stocks into bonds. But that's the chart I would be watching right now to look for some sort of indication. The second for the 3 in 3 is the chart of the S&P 500, just to highlight over the last year this potential non-confirmation or bearish divergence with higher highs in price and lower peaks in the RSI. This feels very reminiscent, just from a technical perspective, to what we saw back in July, with a higher high in price with a lower peak in RSI. That's the last time we had a big divergence. Now, again, that's just one other time over the course of the 12 months, but in general, broadly speaking, that's what tops tend to look like. So again, it definitely doesn't mean we're going to go to zero, but it certainly can mean we can have a meaningful pullback. And it's interesting how that, as I asked Roman, how that compares to what has essentially been a very, very bullish tape going into year end. The final thing I would tell you is the offense versus defense in consumer. We've used this chart a number of times. Since we looked at it last, it's just almost to a pretty bullish layout. This is the XLY versus the XLP. So looking at the two sectors, it is getting right up to trendline resistance, has not broken it yet, but pretty close to breaking to a new high, which would be pretty significant because that's been 7-8 months below that trend line. Also, if you look at the equal weighted versions, this is the equal weighted consumer discretionary versus consumer staples, has been improving and now testing a new swing high, testing a high from the first week in November. So this is almost at the point of signaling more of an all clear, more of a rotation away from defense into offense and more into consumer discretionary. So that's the third chart that I would pay attention to. And folks, that is our show for today on a nice Wednesday afternoon here in Redmond, Washington. I want to thank you for joining us here on the Final Bar. Please keep your questions coming. We love to do the mailbag segments. You can get to us at the Final Bar at StockCharts.com. We are just testing YouTube Live. We tested it this morning. We'll look forward to sharing that with you in the coming weeks. So if you've not subscribed to our YouTube channel, please do it now. For StockCharts in Redmond, Washington, I'm Dave Keller. Have a good night.